Okay, can you hear me? Yeah, now you can. How does it feel to come back from break to this cold weather, right? Anyway, welcome back. I kept my promise, right? I didn't email you for almost a whole week, so that's over now. So now the nagging will begin big time. You thought the first half of the semester was nagging? Now is when the real nagging begins. And I'm going to start right now. If you haven't read the case, read it soon, right? It's due a week from Wednesday, so it's not like you have the luxury of time. It's gone. That's beyond you now. So read the case. You don't actually have to have a group meeting before you read the case. There's no point. So everybody's had to have read the case. And somebody's got to start doing the work, right? Because it's just a collection of facts that I've thrown at you. Your mission is a very simple one. You just have to tell me whether you will take the investment or not. That's the end game, right? So don't lose sight of it. The reason I say that is you will get stuck on little details. So the entire group is going to get focused on some small number somewhere. And the key thing to do is to step back and ask, is that going to make a big difference in my final decision? So it doesn't mean the details don't matter, but don't get stuck in the details. Remember the end game. Do you even know what I'm talking about? There is a case that's due next Wednesday. It's been out there for a week and a half. It's basically a case I concoct every year. So last year it was Apple iTV or something. I don't even remember. Apple iCar. 2 years ago it might have been Nike apparel. So this is just so I've given you the essential information you need, and you can use whatever tools. And much of what we're going to do in the next 3 sessions is going to be directly related. Actually, the next 2 sessions is going to be directly related to the mechanics of what you need to do. In fact, I'm going to take you back a week and a half. Because I know that last Wednesday passed in a blur. You were already in spring break mode. But here's what we did. We started the analysis of how to measure returns in a project. And I gave you a hypothetical project, Rio Disney theme park, actually 2 theme parks. And I said, I'm going to be a number cruncher. You're going to be my decision maker. So basically, I'm going to feed you numbers at every stage, and you have to decide whether based on those numbers, you will take the theme park. So I started building the numbers for the theme park. And this is basically what you're going to be doing on the project as well, starting with revenues and expenses. And I came up with operating income each year. And I showed you the operating income. The operating income was a loss in the first year because you hadn't built the theme park yet. And as you went through time, the losses became profits. And by the time you got to year 10, you were making $422 million in profits on this theme park. And I said, would you take the theme park? And he said, well, that's just a dollar value based on how much I invest. It might or might not be good. So I converted that dollar operating income into a return on capital, which is operating income divided by the total capital, book value. So it's a very accounting perspective, but let's hang in with the accounting perspective. The return on capital, again, was a negative number. What the hell is going on here? The return on capital, again, if you look at it, starts negative. And so this is what we computed. So basically in the second column you see the after-tax operating income on the theme park. So this is the last 5 slides. I'm going to go through the last 5 just to kind of get you caught up with it. So there's my after-tax operating income for the last 10 years, or the next 10 years. The invested capital is an accounting measure of capital. So it's basically whatever capex I put in, net of depreciation. I've included working capital because it's part of my investment. My return on capital starts negative, ends up at 9.89%. But because it's changing over time, I try to be helpful and compute an average return. And the average return on capital on this theme park over the next 10 years is about 4.1 to 4.2%. So you're Disney saying, should we build this theme park? You have to compare the 4.1. You are making money on this theme park, right? So let's get that out of the way. Are you making enough money becomes the question. And we looked at the comparison. We said you cannot compare to the risk-free rate. Remind me why? It's the easy one. Because it's not risk-free. So that gets it out of the way. You cannot compare to the cost of equity. Why not? because of the way I measured returns. I looked at total operating income, not net income, and total invested capital. You're saying, what would you have to do instead to use cost of equity? If I'd use the net income on the theme park, which would be after interest expenses, and divided by just the equity portion of my investment in this theme park, which would not be the total investment, I'd have a return on equity. If I'd had a return on equity, I'd have used the cost of equity. But because it's return on capital, I can't use either cost of equity as my hurdle rate. And then came the choice, should I use the cost of capital for the entire company or the cost of capital for theme parks? And we've kind of resolved this already. We said when you look at an investment, it's got to be judged not against a company's hurdle rate, but against a hurdle rate for that particular project. So the cost of capital, it looked like we should be using was 6.61%. But then I threw in a curve. I said that is my cost of capital theme parks, my existing theme parks in Orlando, Anaheim, Paris, Tokyo. Hong Kong is just coming online. So they're all in developed markets, and this particular theme park is in Rio. And I said, should we be adding an extra premium? Now, towards the very end of the class, we said we should, but I'm going to review again the rationale for why we need to adjust the cost of capital for where the theme park is. When you, as a company, invest overseas, no matter where it is, outside your own country, there are two types of risk you're exposed to, right? Every company which invests outside. The first is exchange rate risk, which is your cash flows are now going to be in reais or euros or pesos or yen. And when they get converted back into your domestic currency, if exchange rates move, you're going to be affected by it, in good ways or bad ways. The second type of risk you're exposed to is political risk. What's political risk? Some countries may cut off cash repatriations. You can't get cash out of the country. Some might nationalize a portion of your businesses. Some countries are more unpredictable than others. So there's exchange rate risk and all this other country risk. The reason I'm separating the two is the only risk I should be building into my discount rate is the risk that my investors cannot diversify away. So let's take exchange rate risk. Disney is exposed to exchange rate risk. That's undeniable. In fact, any company that invests outside its own borders is going to have exchange rate risk. Remember that HDS page we looked at for Disney, the top 17 investors? You had Laurene Jobs and George Lucas, but they were not the marginal investors. The marginal investors in Disney were BlackRock and Fidelity and State Street. Do you think they can take care of themselves when it comes to exchange rate risk? And think of what? If you're BlackRock, does a stronger dollar help you or hurt you? It's a trick question. It can cut both ways. You own pretty much every stock in the market. Not just US stocks, you have a global portfolio. A stronger dollar is going to help some, and a stronger dollar is going to hurt some. So in other words, if your marginal investors are global investors like that, exchange rate risk will pass through to them. They will take care of themselves. They might care, they might not care. You should never be building an exchange rate risk into your discount rate because it's not risk that you should be factoring in as an additional risk premium. So if this theme park had been Frankfurt Disney, there'd have been exchange rate risk, but guess what I'd have used as my cost of capital in dollar terms? The 6.61%, saying, hey, it's a mature market. There is no country risk here. Therefore, I'm not going to factor it into my discount rate. If this had been in any country with a AAA rating, that is my rationale. But this theme park is not going to be in Frankfurt. It is going to be in Rio. And that's the last thing we did. Given that it's in Rio, we have to bring in that additional country risk. And here we already have the mechanics nailed down for figuring out how much that additional country risk has to be. We look up the default spread for the country. We scale it up for the additional equity risk. Remember the cost of equity calculations we talked about. And the only thing I changed was in my risk premium number to get my cost of equity for this theme park, I started with the US dollar risk-free rate. Remind me again why? This is a Brazilian theme park. How come I'm using it? Because I'm doing all my analysis in US dollars. So I start with the US dollar risk-free rate. I use the beta for theme parks. The fact that it's a Rio theme park doesn't matter. It's still a theme park investment, and that beta came from looking at publicly traded theme park companies, 0.7537. But I used the equity risk premium for Brazil, not the equity risk premium for the US or some weighted average. Now, do you see the so basically, if you're GE now, you now have the mechanism for adjusting your hurdle rate, even if you're doing everything in dollar terms for different countries. Because as the risk premium changes, the same project will have different hurdle rates in different countries. That pushes up my cost of equity for this theme park in US dollars to 9.16% and the cost of capital to 8.5%. So instead of using 6.61%, I'm using an 8.5% cost of capital. And if you push me on why is it so much higher, my answer is going to be because the theme park is in Rio. If this were in Caracas, even in dollar terms, guess what that number is going to look like? The country risk premium for Venezuela is 20% plus, and I'm being generous. The plus could be 150% on top. But let's say it's 20%. You put in a 20% risk premium in there. In dollar terms, I will need a 16, 17, 18% cost of capital to invest in Venezuela, which means that I am much less likely to build a theme park right off the top because there's so much country risk in that investment. Any questions on, because this is basically how you come up with hurdle rates for projects. Yes? How did we come up with it for Brazil? You remember? First quiz, right? You've forgotten the first quiz already. You're saying it was not comprehensive, it's all gone, wiped out of random memory. Eh? Somebody can remind me, how did I get the 3% risk premium for Brazil? I started with the default spread for Brazil based on their rating, and then I adjust for equity risk. How did I get the default spread for Brazil? I looked up their sovereign rating. I trusted the ratings agency, right? And in the case of Venezuela, there is a rating and a default spread, but that's what I said. It's probably hit the bottom of the default spreads and kept going. At which point the ratings agency throws up its hands and says, you're beyond redemption. We're not even rating you anymore. So maybe Venezuela is beyond redemption, at which point your default spread goes to 30, 40, 50%. Well, it's a market set number, right? When you go out and borrow money, somebody sets interest rates on you.
Is it just based on the market, or is there an equation?
There is no equation for any of this stuff, right? Because it's demand and supply. Any default spread, any kind of risk premium is a market set number. The more worried about I become about you as a country, the high. I'll give you an example. What was the Brazilian default spread when I did this? November 2013 was 2%. You know what it was in mid-2016? It was 5%. The default spread had widened from 2 to 5. You're saying, what happened? Well, if you've been tracking Brazil, you know exactly what happened. You had a president being impeached, you had political corruption, you had half the legislature essentially being, indicted on some. So basically, a whole set of bad things happened, a series of unfortunate events, which all pushed up the rating, and that rating, pushed down the rating, and the default spread went up. You're right. When you get to a point that Venezuela is at, you might actually have to give up on it. At which point, you're saying, what does that mean? Well, if your risk premium essentially moves towards infinity, which is what it means when you give up, which means nobody will be willing to lend you money at any interest rate because they don't trust you. What does it tell you about businesses investing in that country? Your hurdle rates go towards infinity, so no matter how good a project is, you're not going to invest. So what does that mean for the economy? So there are consequences, there are logical consequences, but essentially think of that as your limiting case. When you get to a point where your default spread goes to infinity because nobody will lend to you, your hurdle rates are also doing the same thing, and as a consequence, nobody will invest.
A big part of it is the market perceptions, right?
Well, the perception in this case is based on reality, right? There's no yes and no. Have you been to Venezuela recently? Don't go there because you will not. In fact, I was listening to the World Baseball Classic. The Venezuela has a very strong baseball team composed of players who mostly play in the major league, and they were talking about the fact that they used to go back to Venezuela for Christmas. They haven't gone back almost in a year and a half. And they're all aware of how much disaster is unfolding. So in this case, you can talk about Brazil and say perception, 4% or 5%. The reality is, if Venezuela went out to try to borrow money, nobody will lend the money now. That's the reality of facing, and that's the reality that the market is trying to reflect in the kind of default spreads you see on these bonds. Sometimes markets are wrong, but I'll tell you what, sometimes ratings agencies are wrong, sometimes you and I are wrong. Everybody's going to be wrong. I'd much rather take a crowd wisdom here than try to impose my views on a particular country. So the riskier the country, the higher the hurdle rate. So remind me again, if you want to get a hurdle rate for a project, what are the things you need? First, you have to decide on what currency you're going to do the analysis. Make that choice up front. Second, you have to do what? Figure out what business the project is in, not what business your company is in, but what business the project is in. Come up with a beta for that business. And then adjust it for your company's choice and how much debt they use, right? What's the third thing you need? You need a measure of equity risk premium. That's going to be determined by where your project gets its revenue. So if I say your project is going to be entirely in the Baltic states, or the Balkan states, or in Southeast Asia, the equity risk premium you'll use for this project will reflect where you think this project will get its revenues. Risk-free rate comes from your currency choice. Your beta comes from the business the project is in. And notice I emphasize the word project, not your company. The project is in. The debt to equity ratio will be determined by how much debt you choose to take to finance this project, and the equity risk premium will reflect where this project will get its revenues. So at this stage I have a US dollar cost of capital for Disney of 8.5%. What was the return on capital I just showed you? 4.1 to 4.2%, right? So you ready? Here's my first question for you. And remember, I'm the number cruncher, so I'm doing all the dirty work. All you have to do is sit there and make a decision. How difficult can that be? So the return on capital on this project is 4.18%, even if I take the higher of the two numbers. The cost of capital for this project, given that it's a theme park in Brazil, is 8.5%. This seems like a slam dunk, right? Don't take the project. The return on capital is less than the cost of capital. But before you make that final decision, I'd like to slow you down a little bit. The return on capital I computed for this theme park of 4.18% came from projecting numbers for the next 10 years, right? But why did I stop after year 10? What was so magical about year 10? You know, half of all capital budgeting in the US uses 10-year lives. What is this 10-year life? Why not 9? Why not 11? Why not 7? Why not 12? Why 10? It's actually a trick question. Nobody really knows. In fact, I think my reason for why it's 10 is what fits comfortably going landscape and Excel on one page. You think that is absurd. People don't make decisions based on that. You know how infuriating it is when one column keeps popping up page after page after page? I know we now have shrink to fit. But before shrink to fit, 10 years was one wet landscape on one page. There is no good reason. You think we have to stop somewhere. You're right, you have to stop somewhere. But on this particular investment, I think I'm being incredibly unfair to this project by stopping after 10 years. What kind of project is this again? A theme park investment, right? Does Disney already have some existing ones on the ground that I can look at? Well, let's start with Disneyland. How old is Disneyland? I remember watching that 50th anniversary commercial for at least 8 years. It's at least 58 years old. I think it's what, 1958. It's 59 years old. Disneyland is 59 years old. It makes more money for Disney now than it did 10 years ago, 20 years ago, 30 years ago, and definitely a lot more money than it made in the first 10 years. Same story with Disney World. 46 years old, makes more money for Disney now than it did 10 years ago, 20 years ago, and definitely more money than in the first 10 years. The first 10 years for big infrastructure investments are the disaster years. You tend to lose money because you're building up. I still remember all those stories coming out of Rio Disney in the 1990s talking about how horrible this was as an investment for Disney. And my reaction was, did you look at Disneyland in the first 10 years? Euro Disney was actually doing better than either Disneyland or Disney World in the first 10 years. But if you focus on those first 10 years, you are going to get some abysmal looking numbers. Which means I'm actually killing this project just as it's starting to become a cash cow. If I'd stopped Disneyland after 10 years, I would never have opened it. If I stop Disney World after 10 years, horrible investment. Euro Disney after 10 years, I would never have made it. So by stopping after 10 years, I've essentially tilted you away. You're saying, but you're being equally I mean, so you're saying, if I'm doing this for every project, so what? If some of your projects are long-term projects, let's say you're comparing investing in Beauty and the Beast, the new version, versus investing in a theme park. Putting a 10-year limit on Beauty and the Beast is not going to affect my decision because it's a much more short. So you're going to tilt yourself towards short-term projects if you arbitrarily stop every project after 10 years. And with accounting returns, there's not much you can do unless you're willing to do year 11, year 12, year 13, year 14 and keep pulling your spreadsheet out. But with cash flows, there's actually a very interesting, a very easy technique you can use to bring in what happens after year 10 without ever having to do year 11, year 12 explicitly. We'll get to that. But with accounting returns, the reason I'm slowing you down is, hey, this looks bad right now, but maybe it looks bad because I've been unfair and cut the project off after 10 years. Now let me pause. I said a good measure of return for a project, if you remember in the last class, is based on cash flows. Those cash flows should be incremental and they should be time weighted, right? A good measure of return should be a time weighted incremental cash flow return. The measure of return we've used up till now is an accounting return on capital. So it's not based on cash flows, it's based on earnings. Did I look at incremental versus non-incremental? No, I thought like an accountant. I said all expenses allocated G&A, it's an expense. And I didn't time weight it, right? I just took a simple average of those returns. This is about as far as you can get from a good measure of return, right? Saying, why do we waste our time on this? If any of you worked in corporate finance or even investment banking, one of the metrics that has become almost a religious metric is this return on invested capital for a company. Analysts compute the return on invested capital for a company. They compare to the cost of capital. Essentially, they're saying, if I'm a good company, I should earn more than their cost of capital. There's actually a core of truth to it, just as there is in any imperfect metric. So let me go back and show you the financial balance sheet with which we started the class. On the asset side, remember I broke assets down into assets in place and growth assets. So you take any of your companies, including the company you're working on as your long-term project. If you look at the financial balance sheet, you have assets in place and growth assets. Now, during the course of the class, you're going to ask all kinds of ambitious questions about your company. Is it got great investments? What about future projects? But here's a question that I think you should start with before you get ambitious. You want to know whether this company has taken good projects in the past, right? Because that would be good to know before you tell me that they're going to take great projects in the future. Your track record might tell me something about your future. So here's one thing I can do. I can treat all of your existing projects as if they were one big old project, a project you already took. Take the invested capital, the book value of what you've invested in those projects is what you put into those projects, and take the total after-tax operating income you have as a company as the income generated by all those projects. This is a portfolio of all projects. I'm asking, does that portfolio generate enough of a return given the risk you took? That sounds abstract. Let me take Disney as a company. Disney as a company generated $6.92 billion in after-tax operating income in the most recent 12 months leading into 2013. $6.9 billion. If you look at their balance sheet, and this is the only place in finance where you're going to see me use book value, here's what the accountants tell me they've invested in these projects. You take book value of debt plus book value of equity, and I'm going to subtract out cash. You see why I want to subtract out cash? Because the cash obviously is not invested in projects, it's just sitting there. I get what's called book value of invested capital. The book value of invested capital at Disney is $55 billion. So let me give you the two numbers again. The after-tax operating income is about $6.9 billion. Their book value of invested capital is $55 billion. If I divide the after-tax operating income by book value of capital, I come up with a return on capital collectively across all their projects of 12.61%. You're saying, is that a good number, a bad number? Well, I have a cost of capital for Disney as a company. Remember the 5 businesses, I broke it down, I took a weighted average. The cost of capital for Disney as a company is 7.81%. I know it's very simplistic, one slice of history, but to the degree that I trust the accounting numbers, It looks like they're earning about 4.8% more than their cost of capital. This is where all the strategic stuff and barriers to entry and competitive advantages meets reality. Because if we take a strategy class, we talk about barriers to entry, competitive advantages. If you truly have competitive advantages, this is where it should show up, right? You're earning more than your cost of capital. So in the case of Disney, if I pause right there and say, why does Disney make more than its cost of capital? The answer is not because they earned a lot of money last year. It has to come from some core competitive advantage that they have that allows them to earn more than the cost of capital. So what's Disney's competitive advantage? What allows them to earn more than their cost of capital? No, Disney's not that mysterious a company. What does Disney have that other entertainment companies don't seem to have? Well, or more generally, they've created these characters that you can't really replicate, right? I mean, let's face it, Mickey is tough to create from scratch because it has a 70-year history and it's kind of embedded in our consciousness. So some of this comes from Walt Disney putting together that very first Steamboat Willie. Have you seen that? The very first Mickey. So you have a history here that's paying off as, so it is, there is that animated movie part, but in a sense they built on that, right? If you think about their successful movie franchises now, it's really not the animated movies that are the bulk of their value. One is Marvel, which they bought for $4 billion and turned around. And the other, of course, is Lucasfilms, which is an ongoing franchise. And Pixar, of course, is this, you know. But there's something that Disney seems to bring to this realm of the movie business that makes them better at it than their competition. Where does it show up? As excess returns. But to show you that nothing is permanent, 10 years ago, if you'd looked at Disney in 2003, this was at the waning days of Michael Eisner's days as CEO. Their return on capital is actually 1% less than the cost of capital in 2003. So Mickey is not going to protect you from bad management. I can take a company that has incredible competitive advantages and essentially wipe them out if I try hard enough. But it shows you again that it's a proxy for what does this company do that is, you know. If you look at Vale, their return on capital is 10.41%, their cost of capital was 8.2%. Their excess return in 2013 was 2.22%. What is their competitive advantage? They own these iron ore mines, and presumably iron ore was going to grow. But if you track that excess returns through 2014, 2015, and 2016, guess what's happened to those excess returns? As iron ore prices have dropped, those excess returns have hit zero and kept going. Vale right now earns about 2% less than its cost of capital. And it's not necessarily because it's managed badly, but because its core value came from commodities. And if commodity prices drop, it's across the board a drop in your excess returns. So there the excess returns are as much a function of macro factors as they're a function of micro factors. Baidu's excess returns are an astonishing 18%. Two reasons for that. One is it's a technology company. You think, so what? What's in the denominator for your return on invested capital? It's book value of debt plus book value of equity minus cash, right? One of the problems you face with technology companies is their biggest assets are not on the books. Because when you do CapEx as a technology company, it's R&D, right? R&D is expense. And because it's expense, your invested capital never reflects your biggest assets. So part of this is just accounting inconsistency, but part of it is real. I mean, I won't argue that it doesn't earn it probably earns a pretty substantial excess return. So what's at the core of Baidu's excess returns? Why does it earn more than its cost of capital? Why does it in competition come in and wipe out those excess returns? Come on, you know the answer to this. Because the Chinese government acts as your enforcer. The reality is, if Baidu really had to compete in a global marketplace with search engines, it would not be making a 17.6% excess return. So there's another source of excess returns. Is if somebody stops the competition from coming in, that's effectively going to push up your excess returns. Tata Motors was earning a 9.55% excess return in November of 2013. And almost all of it was coming from one part of Tata Motors. which they acquired in 2009, which is the Jaguar Land Rover part. Tata Motors India has actually hit cost of capital and kept going. So they're basically earning less than the cost of capital. But Jaguar Land Rover, at least in November of 2013, was earning well above the cost of capital. See, so all I'm saying is when you compute this for your company, and you will have to at some point in time, look at the number, but look past the number. Ask yourself, where are these excess returns coming from? And then ask a follow-up question. Do I think I can maintain these excess returns? Because your value in the future rests on whether you can create these excess returns. Any questions on this excess return? So basically two numbers are driving. One is the cost of capital, the other is the return on capital. The cost of capital is a market set number. It reflects the market price of equity, the equity risk premium, your default spread. The return on capital is an accounting number with all of its caveats. But at least as a rough approximation, it gives you a measure of whether you've earned more or less. Yes?
Is this a similar measurement like Jensen's alpha?
No, Jensen's alpha is a pure market measurement. The question was, is this similar to a Jensen's alpha? Jensen's alpha is what you as a stockholder make in the market after adjusting for risk. Can a company with horrible excess returns give you a positive Jensen's alpha? Yes, because here's why. You buy a company with horrible excess returns and it does a little better than expected. It earns only a minus 7% excess returns or minus 9%. What do? You push up the stock price. Jensen's alpha just measures how you perform relative to expectations. So if I expect you to be an abysmal company and you're just a very bad company, that's a positive surprise. So I reward you with a higher stock price. So Jensen's alpha is purely a stock price return. This is actually what you're making on your projects as an operating income. Question? No. So at the start of every year, one of the things I do is I compute the return on capital and cost of capital for every publicly traded company in the world. Sounds like a lot of work, but it's just a gigantic Excel spreadsheet. 42,000 companies at the cost of capital, one company for each company, the return on capital. You know why? Because I'm curious. I want to find out, do companies typically earn more than their cost of capital? If so, how much? Because this is at the core of comparative marketplaces, right? As I do that, though, I am walking in with open eyes. And this is what I mean by open eyes. The return on invested capital is a pure book value number. It's a pure accounting number, and here's why. In the numerator, you have operating income, which is an accounting number. In the denominator, you have book value of debt plus book value of equity, which is an accounting number. You're saying, so what? Everything accountants do to those numbers is going to affect your return on invested capital. Part of my job often, when I value a company, is to take the accounting return on invested capital and clean it up. Clean it up for what? For all the things accountants do to try to help you. I'll give you an example. Chevron, about 6 years ago, invested in this gigantic energy project off the coast of Australia, a $55 billion project. At the time they did this, oil prices were $100 a barrel. So they thought it was going to be a good project. So this project is now complete. It took 6 years to be complete. It's ready to go online. But two problems. One is oil prices have dropped from $100 to $50 a barrel. So the project clearly, if they were taking the project today, they wouldn't even look at it. It's a horrible project. But the money's already been spent. So it's a bad project. Everybody knows it's a bad project. The accountants too even have come to the conclusion it's a bad project. So guess what they've done at Chevron? They've taken the $55 billion and they've written it down to $30 billion. You're saying, that's a sensible thing to do. That might be, but here's why it's a problem. Let's suppose next year I'm looking at Chevron and computing the return on invested capital. I'm going to see $30 billion, right? Because they've written down the book value to $30 billion. And based on the $30 billion written down value, the project looks pretty good. It looks like they're making 12%. So if I did not know that they wrote off $25 billion, I'm going to conclude Chevron takes great projects. Look, they're making a 12% return on invested capital. So you know what I have to do to measure the return on invested capital for a company? I have to go and add back all the amounts written off in the last 3, 4, 5 years to the invested capital, saying, I shouldn't have done that because I want to capture whether your projects were good or bad, and you're countering that by writing off stuff. Goodwill, another major issue in return on capital. What do I do with it? Because when you acquire a company, you see $10 billion pop up as goodwill. If you count the goodwill, it looks like your return on capital went down, even on good acquisitions, because you're paying for future growth. So many analysts take out goodwill or a portion of goodwill to come up with a return on invested capital. So there are a series of accounting adjustments that affect operating income invested capital that can skew your return on invested capital. Remember leases? We talked about capitalizing leases and treating them as debt. If I don't do that, the return on invested capital for Starbucks looks like it's 18%. If I do that, or capitalize leases, it becomes 13%. So part of what you're trying to do here is get a better sense of, is my company taking good projects? Because if you cannot answer that question, everything else in corporate finance and valuation becomes almost pointless. Do any of you have insomnia problems? If you do, I have a solution. It's a paper I've written on return on invested capital. That was so incredibly boring that I fell asleep multiple times while I was writing the paper. It was about all the adjustments I have to make to accounting numbers to get a better measure of return on invested capital. And I had to do it because without it, I don't have that base number. So with all those caveats, I do this number for every company. So I capitalize leases, I bring in R&D. So I do the best I can to fix the numbers. And I come up with a return on invested capital for every company. 42,000 companies, return on capital, cost of capital. I compare the two numbers. You want to see what the numbers look like for 2016? In 2016, here's what the world looked like to me. There were 10,961 firms that earned a return on capital that was lower than the cost of capital by 2% or more. So a third of all companies are earning less than the cost of capital. About a third of all companies are earning roughly their cost of capital. There's a great symmetry to this process. So a third earn more than their cost of capital. So the first thing I'm preparing you for is when you look at your company and it earns less than the return on capital, don't freak out. This is not some uncommon occurrence. 1/3 of all companies earn less than their cost of capital. And you would expect something, as competition increases for product markets, you would expect something like this. It has to be difficult to earn more than your cost of capital because we're a slam dunk. New companies be entering in like crazy. So when you look across the publicly traded marketplace, you see this breakdown of about a third, a third, a third. A third earn roughly their cost of capital. They're running in place. A third actually destroy value when they take projects. And here's the follow-up. Of the third that earn less than their cost of capital, a big chunk have been earning less than their cost of capital every year for the last 10 years. Now that's a tougher puzzle to solve, right? Because if you earn less than their cost of capital, what do we say in corporate finance is a logical thing to do? If you find yourself in a business where every project you look at earns less than the cost of capital, what should you do? First, on projects, stop taking projects, right? If you can get out of the business, would you? Yeah, you want to shrink. You're saying, why don't these companies do it? Why don't they try to make, because many of these companies that earn less than the cost of capital actually keep investing more and more into that business. I don't know what the end game here is, but they seem to have lost track of the end game. And in fact, I have a post that I'll send you a link to on why do companies stay in bad businesses? Because that's basically the question you're asking. Why, if you're in a bad business, do you keep trying to grow in that business? And there are entire businesses where this has happened. The automobile business, the airline business, where growth, you can almost see the end game is you're not going to earn your cost of capital. But you can see that play out. Any questions on this comparison? So when you see investment banks and analysts and consulting firms do this comparison, you can see what they're trying to do, but also look at it with open eyes. Recognize that the return on capital is an accounting number. Check to make sure it isn't an accounting issue that's making your company look good or bad before you conclude that the company has a problem. So when you get to this stage in your project, which you're not even close to, so you're not even within sniffing distance of this, right? Once you get your cost of capital, compute the return on capital for your company. See whether your company is one of those third that earns more than the cost of capital, one of the third that's running in place, or one of the third that actually earns less than the cost of capital. Because that's going to become a big foundation for almost everything else you do on the rest of the project. Okay? So that's the accounting return on capital, and the accounting return on capital for this. So let's return to the project, the Disney theme park. Based on an accounting return on capital, the project doesn't look good. But I already said that's not a great way of measuring returns. because it's based on accounting earnings. So here's what I'm going to do. I'm going to take the accounting earnings on this Rio Disney theme park, first move to cash flows, and I'll talk about the adjustments I have to make, then go from cash flows to incremental cash flows, and I'll talk about the adjustments I have to make, and then finally take the incremental cash flows and time weight them. So let's start with the first of these three steps. To get from accounting earnings to cash flows, there are three adjustments I need to make. First, I need to add back depreciation and amortization. Remind me again why? Because it's an accounting expense, not a cash expense, so add it back. I need to subtract out capital expenditures. Why? Because it's a cash outflow. The fact that the accountant says it's not an expense doesn't mean I don't have to spend the money. And I have to subtract out changes in working capital. And this is always the mysterious item. What am I doing there? I'm really taking accrual earnings, where I'm required to record transactions as they happen and make it into cash earnings. This is standard. These three adjustments never change. You get from earnings to cash flows. I add back depreciation. And now the numbers start to actually make sense. Because my accounting earnings, if you think about it, I had no earnings in year zero, no earnings. But you're saying, but I'm spending a lot of money. What's going on? Accounting earnings don't record capital expenditures. Now I'm showing them as cash flows. So guess what? For the first 4 years, I have big negative cash flows because I'm building the theme park. And then the cash flows start to turn positive, and they get more positive over time. I'm going to take each of these adjustments, the depreciation adjustment, the capex adjustment, and the working capital adjustment, spend just a minute or two on each of them. If you think about it, to get to operating income, I subtract our depreciation, right? And then after I've got the after-tax operating income, I add depreciation back again. So your first reaction is, why bother? Why even think of, if you're going to subtract it out and add it back, isn't it a non-issue? Why don't we just start with EBITDA? And I've seen people actually do cash flows starting with EBITDA. They're saying, because you're going to add back the depreciation anyway, why subtract it out? That's a mistake, and here's why. Even though I subtract depreciation to get to operating income and then add it back, it's not a neutral item, and here's why. My taxes are based on the operating income. My depreciation actually saves me taxes, so even though I add back depreciation, I leave an imprint on the cash flows, and that imprint is equal to whatever my tax benefit is from depreciation. I don't want to be mysterious. In the example that I just had for Rio Disney, if you remember, the depreciation was an expense. This is how much I'm saving in taxes each year because of the depreciation. I just take the tax rate times the depreciation. That's how much I would say. If you don't believe me, just redo the entire analysis without depreciation, and you're going to see less cash flow each year because you don't have depreciation. So the bottom line is depreciation matters because it creates a tax benefit. Last week I got a call from somebody at a nonprofit, and they're working through a cash flow statement. Don't ask me why, for a nonprofit. And they said, we're trying to figure out depreciation. We're having a lot of trouble estimating depreciation. And I said, why do you even care? He said, no, I have to get depreciation to get the right cash flow. Why does it not matter if you're a nonprofit? Your tax rate is zero. If your tax rate is zero, you can depreciate, you can amortize, you can do all the dances you want. It doesn't matter. Your cash flow is going to be exactly the same with or without depreciation. It's only if you have taxes that depreciation comes into play. And the higher your tax rate, the greater the benefit you get from depreciation. One of the problems when you have divergent tax rates within an economy, you know what I mean by divergent tax rates? Let's say I tax individuals at 70% and corporations at 35%. I create a setup for all kinds of follow-up businesses. So you're an airline, you have a 35% tax rate. You're really wealthy individuals with a 70% tax rate. What did we just say about depreciation? The tax benefits are greatest to those with the highest tax rate. Now you guys don't really need a Boeing 747 parked in your backyard. So let's say you're not one of those people who needs a Boeing 747. Is there a way in which you could get the tax benefit and they can continue to use the aircraft? You can buy the aircraft, you get the 70, and you claim it as yours, and you lease it out to the airline, right? So you get the 70% tax benefit when you claim the depreciation, and you share some of that tax benefit with the airline. So in a sense, both of you gain. There's a loser. The loser, of course, is the taxpayer, but who cares about the taxpayer? They're outside the door anyway. During the 1960s and 70s, this was the basis for the leasing business because the highest marginal tax rate for individuals was 70% and the highest corporate tax rate was 35%. And once you have those divergent tax rates, you are going to get this business going. The leasing business almost died in 1986. Why? Because the individual tax rates came down to about 30 to 35%, kind of matching up the corporate. So you no longer have the incentive to do what you did before. So when you have different tax rates, you can see why you're sometimes going to get the owners of the asset be separated from the people who actually use the asset. So here's my suggestion if you're a non-profit. Rather than you buy the equipment, the machinery, etc., and claim depreciation, which you get no tax benefit, you might figure out a way to kind of lease this from somebody who does have a tax benefit from depreciation, and I'll wager this happens all the time. I'm not familiar with how hospitals pay for that expensive equipment, but I'd be very surprised if this is not happening already, because it happens every time you get divergent tax rates. Any questions on depreciation and amortization? Let me follow up on this then. In the old days when you took accounting and you went to the depreciation chapter, they talk about different kinds of depreciation methods. The reason they've stopped is today actually, if you look, especially in the US, your depreciation tax is set by a tax schedule set by the IRS. But in the old days you could decide whether you wanted to use straight line depreciation, which of course was the easiest of all depreciation methods to work with, or some form of accelerated depreciation. Some of the years double declining. I'm not going to go to the specifics, but in accelerated depreciation, you get exactly the same total depreciation. So if you're getting 5 billion depreciation with straight line, you get 5 billion with accelerated as well, but you get more depreciation in the early years and less in the later years. So I have two separate questions. If your objective is to increase earnings this year, and you've just bought this equipment that you can depreciate with either straight line or accelerated depreciation, if your objective is to report the highest earnings you can, which depreciation method is going to give you higher earnings, straight line or double declining, or some accelerated straight line, right? So when you report earnings, you want to use straight line depreciation. Now let me flip the question around. If you want to increase cash flows this year, remember cash flows are after taxes, which depreciation method works better for you? The more you can accelerate your depreciation, the less you pay in taxes. The less you pay in taxes, your cash flows are higher. I'm putting you right in the spot. Which should you rather increase? Would you rather increase earnings or cash flows? And your answer is going to be both. And I'm going to let you do both. How? In your reporting books, which is what you use for your 10K, what do you tell me your depreciation is? Tell me straight line depreciation. In your tax books, it's accelerated. You know that effective tax rate for some of your companies is doing some really strange things? That's assuming you've picked a company and you looked at it. Some of you have negative effective tax rates. Tax rates that jump around. One reason for that is you have two sets of books. Your taxes come from your tax books. Your reporting statements reflect the choices. If you make two choices on depreciation, you're going to see that show up as very strange looking effective tax rate numbers. So with depreciation, you can see how when you do taxes, you want to get as much depreciation as you can. Whereas when you do your income statements and you want to report earnings, you want to claim as little depreciation as you can. But don't take that little depreciation you have in your reporting books and use it in your tax as well, because you're leaving a lot of money on the table if you do that, because you're going to be paying far more in taxes in the upfront years. You'll pay the same amount in taxes over time, but the present value of the taxes you pay will be much greater if you use straight line in your tax books. Yes?
In terms of finance, which one makes more sense? I mean, we got the accounting, we got the tax.
Come on, this isn't even finance. In terms of common sense, would you rather have more cash or less cash? More cash, okay. That's it, we're done. This is not finance, this is a common sense. Who thinks in accounting earnings terms?
So you want to write off the whole thing?
Absolutely. I'll write off 10 times the whole thing if you let me do it too, right? And pay no taxes for the next 7 years. You'll call me a loser every step of the way. I'll deposit $5 million in the bank every single year. I'm okay being labeled a loser. I get to spend $5 million. Let go of this. Just because you've taken an accounting class doesn't mean you have to let them brainwash you on what it actually means. ultimately it's cash in, cash out, and you can spend only cash flows. So this is an accounting versus finance, accounting versus common sense, and you decide which one you want to go with. I'll go with common sense every single time. It's only after you get an accounting class that you say, maybe I should think about earnings. Maybe we have a good sense until we get this accounting earnings kind of swirling around number. You should not be making decisions based on earnings. You can report nice looking earnings. I can understand why you want to reframe things, but ultimately it has to be cash in, cash out. Let's move to capital expenditures. Right? Any other questions on depreciation and amortization? Right. Incidentally, a big chunk of amortization is not tax deductible. Give me one example of an amortization, a big item that's not tax deductible. Remember that impairment of goodwill that we spend so much time hiring accountants to do this impairment dance? Most impairments are not tax deductible. So if they're not tax deductible, what do they do to their cash flows? Absolutely nothing. And this is why I've never understood why we spend so much time on accounting impairments of goodwill. I'd much rather go to the old system. The old system was pre-99. Here's what you did with goodwill. You wrote off 1/40th every year for 40 years. Completely automatic, completely not connected to what might be happening. But guess what? It took you 2 minutes to do every year. Now you have to bring in Deloitte or KPMG, and they spend 3 weeks looking at your goodwill. They charge you like $15 million for doing this and say your goodwill went down by $2 billion. You write off the $2 billion, and nobody seems to care that you wrote off $2 billion because they knew it already. It doesn't affect your cash flows. It's a complete waste of time. So it might actually be interesting to take a scalpel through all these impairments and amortizations and remove those that don't affect cash flows. And if they don't affect cash flows, stop even thinking about them. They're not changing your end game as a company. Now let's talk about capital expenditures. When you think about capital expenditures, here's what I want you to think about. I want you to think about investments that create benefits over many years. Kind of a generic definition. So when you look at a project, you have two types of capital expenditures you can have in a project. The first type of capital expenditure is expenditure you make to get the project started, that initial investment, the land, the building, equipment. The second type of capital expenditure is more subtle. So in the case of the Rio Disney theme park, the new investments will be the new theme park you're building in the next 3 years, right? But after the 3 years that you've spent building the theme park, you're not quite done, because if you want this theme park to keep going, you got to put money into the... Anytime you visit the Disney theme park, anywhere in the world, there's usually at least 1 or 2 rides. Usually the ride you want to take your kid on, that's closed. Have you noticed this? Entire rides are closed for 3 months because they're rebuilding a new ride. Why do they do it? Because if they want people to keep coming back to this theme park, to make it look like an ongoing investment, they have to put money back. There's regular maintenance expenses. This is the guy, sweeping the pathways, making sure that... This is capital maintenance. This is the new ride you're putting in. These are called capital maintenance investments. Not to make your investment grow, but to kind of maintain your investment and keep it going. I'm going to count those as capital expenditures as well. So on my Rio Disney theme park, if you remember, after year 3, I didn't stop reinvesting back in the theme park. I kept putting more money in. You're saying how much money? Here's a very simple test of how much you should be putting back if you want your theme park to go. Think about depreciation the same way you think about calories burnt from exercise. Think of capital maintenance as calories consumed to get back to your steady state weight. If you consistently consume only half the calories that you're burning off, your weight is going to keep... And you might be fine. If you're 500 pounds, that's what you want to happen. But if you're at your fighting weight, if you consistently eat only half or consume only half the calories that you're burning off, you are going to disappear. Same thing applies with investments. Think of depreciation as calories burnt off. Think of capital maintenance as calories consumed. If you want this investment to maintain its fighting weight, you have to think about that balance to keep it going. But they're both cash outflows that will make your overall cash flows less. But it's a trade-off. If you don't put the capital maintenance in, you'll get more cash flows while you keep the investment going. but the investment won't go on for as long. So you can't have your cake and eat it too. You can't say, look, I don't want to put capital maintenance and I want my project to continue forever. Think about that trade-off when you think about capital maintenance. So again here, let me put you to the test. There are some items where you have a choice. Choice of what? You can either expense the entire item or capitalize it and depreciate it. In fact, if you're a small business, there are these special rules that actually allow you to expense up to $50,000. So you might buy a new computer. Normally it's treated as a capex and has to be written off over 3 years. But because you're a small business, you're told, hey, you can write it off if you want. Again, let me ask you the question in terms of earnings. If you're looking at earnings, which would you rather do? Expense the item or capitalize it and depreciate it? Capitalize and depreciate it. You like to spread it out. But in terms of cash flows, you want to expense it right away. Here again, you will see companies trying to have both sides working for them. When they report their stuff in their accounting statements, they'll often capitalize everything, say we're spreading things out. But in their tax books, they will expense everything. So when you think about both depreciation and capex, think about that trade-off between earnings and cash flows, because they will often push you in opposite directions depending on what you're trying to focus on. Any questions on capitalizing and expensing? Finally, working capital, right? I've been teaching here for 31 years and I walk down Bleecker all the time. And when I walk down Bleecker, one of the things I look at is how many stores that I saw last week are still around this week. Forget about last year. This is a place where there's incredible turnover. Restaurants, retail stores. You wonder why. Part of that is the rent, right? But you think that people know going in that this is a high rent district. They must do the capital budgeting in their heads and decide this is a good investment. But one reason I think a lot of small businesses fail is they think about the big expenditures they need to get into the business, which include, hey, how much will it cost for me to renovate the store, make it look good, the capital expenditures. What they don't factor in, especially in a business like retail, is how much of a drain on your cash flows working capital creates. See, what are you talking about? You walk into a store, you look around, there's inventory, right? All those clothes hanging on those racks, or folded on the racks. That is money you've already spent to get that, and until you sell that, that cash is tied up. That's what the change in working capital brings in, is the more money that you have invested in inventory, and the more money that you have invested in giving credit to others, that's less cash flow for yourself. And guess what? The more successful you get, the more your working capital needs will have to increase, because if you're selling a lot of stuff, you've got to keep stocking more. If nobody ever walks in and buys stuff in your store, you can have only 2 items in the store. So nobody comes in here. So the more successful you get, the more your working capital will have to get replenished and increased. So when you think about working capital, there is that initial working capital you need to get started. Why? Because to even open the store, you need inventory on the shelves. And then there is this continuing working capital, because you can't just let everything sell down and then replenish it. Every evening you got to look around and say, what have I already sold? What do I need to replace it with? Which effectively means that what you get as cash flows as a retail business will be far less than what you see as accounting earnings on that business, because much of that earnings is tied up in working capital. You'd be amazed at how many businesses go out of business while they're making money, but because they have a cash flow problem. You think, if you're making money, how can you have a cash flow problem? Easily. You're making money on an accounting earnings basis, but your cash flow problems reflect the fact that a lot of the money is tied up in inventory. So it's almost imperative when you look at a project that you have to consider both the initial investment and changes in that inventory. It's not, so once you've invested $1 million in inventory, that million is tied up, but if you decide to increase your inventory to 1.2 million, you've got to come up with an extra 200,000. You go from 1.2 to 1.25 million, another 50,000. So basically every time inventory increases, you're effectively tying up more cash flow. So let's bring the cash flows together, and let's go from cash flows to incremental cash flows. There are 2 items I now want to bring into the picture that I mentioned before, but I now have to deal with. I'll give you a very simple test of how to decide whether something is incremental. There are 2 questions you need to ask. First question is, you have to ask, what will happen if I take this project, Second last, what will happen if I don't take this project? If you get the same answer to both questions, that item is not incremental. It sounds completely abstract. So let me give you two examples. I don't know whether you remember, but I told you that up front that Disney had already spent $500 million doing the research and the licensing for this theme park. Already spent. And that if you decide not to take this theme park, you're not going to get the $500 million back. Already spent, not going to get it back. In finance, we have this buzzword we use for this. What is that called? That's called a sunk cost, something you've already spent, and everybody kind of knows what you're supposed to do, which is ignore sunk costs. I'll tell you, it's one of the most difficult things for a human being to do, and we'll talk about why. But at least in theory, if it's already happened and it's not going to change, why let your decision be affected by it? So sunk costs. So one of the things I did is I did the right thing. I took the $500 million out of my initial investment, saying I should never have counted that as part of my initial investment because it's a sunk cost. That's the first non-incremental item. Because if I ask what will happen if I take the project, I've already spent the $500 million. What will happen if I don't take the project? I've already spent the $500 million. This project is making no difference. The second item I want to focus on is this allocated G&A. Remember that little dance I did about Disney taking G&A and allocating to the project? I also told you that 2/3 of the G&A have nothing to do with this project. They're things like Bob Iger's salary. He's not going to take a pay cut if you don't take this project. So let's ask the question, what will happen if I take this project? Well, the 2/3 will get allocated to the project. What will happen if I don't take the project? The 2/3 will just get allocated somewhere else. It's not going to go away. It is a non-incremental expense. So what I'm going to do is I'm going to add back that non-incremental G&A back to my saying I should never have subtracted it out. So essentially the two adjustments I'm making is I'm taking sunk costs out of the initial investment, I'm cleaning up for that allocated G&A and removing the portion of the G&A that I think will be there anyway. Okay. Let me actually give you, take a look at each of these, because as I said, the notion of sunk costs is, I think, very easy to understand. But if you look at these calculations where I clean up for mistakes I've already made, in fact, the other item that I added back is, remember that sunk cost created a depreciation every year, and I treated the depreciation as a tax benefit. That depreciation tax benefit is also going to be there, whether I do this project or not. So I've cleaned up for all of those non-incremental items. It's easy to screw up when you try to take operating income and clean up for these items, and you can see why. Some items I add back, some I subtract out, some are 1 minus T, some are T. So if you want to do an incremental cash flow without having to do all this cleaning up, the best way to do it is actually do everything in incremental terms, which means when you do depreciation, you count only incremental depreciation. When you do investment, you count only incremental investment. If everything is done in incremental terms, you get exactly the same cash flows. And I actually think it's easier to do it this way than the other way, where you start with the operating income and reverse it. You should get familiar with both approaches. But if you want a cleaner look at the incremental cash flows, just focus in on only those items that are affected by this project. I'll give you a very simple example of what's incremental and what's not. About 10 years ago, I was actually doing this session, I don't know, for one of the investment banks, one of the summer analyst programs. It was in a uptown hotel because that's where they decided to do it. The big ballroom, 300 people, incredibly bored, all ready to get on the desk. I'm incredibly bored. I want to get out of there. So it's incredibly bored meets incredibly bored. And I'm going through this class, and it's about the second day. Nobody in the class really cares about incremental, non-incremental. But there was this guy who was setting up catering. These were in the good old days where they gave you ice cream in the middle. So it must have been a good year for investment banks, because you can always tell how well the bank is doing by how well they feed their analysts during the program. So this guy was setting up food, he was giving ice cream during the break, and he stood at the door, and he was the most attentive person by far in the whole room, including me. So at the end of the day, he comes to me and he says, look, I've been listening to you for the last 2 days. And I said, I'm glad somebody is listening. He says, I have a question for you. I was listening to this thing about incremental cash flows you were doing. He says, I have a question. I have a business I'm running. He says, I'm from Guatemala. And every year when I fly back to Guatemala, here's what I do. I go into the Gap or the Limited and buy seconds. You know what seconds are? These are clothes with small damage on them, so you can buy them at a big discount. He says, I spend about $400 buying the clothes, and I fly to Guatemala and I sell it for $1,000. But it cost me about $800 to do the round trip, and all my accountant friends tell me I should stop doing this. You can see why, right? Because they're doing a full income statement in their head. You're saying, well, you're making $600 from selling the clothes. It's costing you $800 to fly. Therefore, you have a loss of $200. Stop doing it. And he says, but I have a feeling that I should keep doing this. So I asked him the question that needed to be asked, which is, are you going to Guatemala anywhere? And he said, yes, my entire family is there. In which case, the $800 is going to be there anyway. At least he's reducing the 800 to 200 by doing what he's doing. And if you listen to his accountant friends, what's going to happen next year? He's going to be still flying to Guatemala, spending $800, saying, what the hell happened now? I'm now losing $800. So what do you learn from this? Don't have any accountant friends. And that's a lesson here. Or if you have accountant friends, don't listen to them, right? Because if you work through full income statements, this is exactly what will happen. You're saying that unsophisticated. You know what? There's a bank that I will leave unnamed, an investment bank, that in the late 90s decided to shut down its Asian equities division, entire division. Why? Because it was losing money. So you take a look at the Asian equities division. It was losing money. They ran all of the Asian equities out of New York in those days. They didn't even have anybody in Asia. And they were losing money. So you look at the line items, there's huge allocated expense. So what is that? It's allocated to Asian equities. And so what goes in there? Anything Asian. So basically you could go for Chinese food and say it's Asian. Let's charge it to Asian equities. So basically you had people charging stuff to Asian equities that had nothing to do with the division. You shut the division down, people still go for Chinese food. And they charge it to structured products or unstructured products or whatever you want to decide Chinese food best fits into. A lot of expenses are allocated. It's amazing how companies make decisions based on, is that division losing money? That's a first level question. You still have to ask a question. On an incremental basis, is that division losing money? Because you can have losing divisions that are still cash flow positive to you, that are generating cash flows. That's at the basis of the incremental versus non-incremental. So let's take a look at sunk costs, right? As I said, you look at any finance book, it pretty much tells you if something has already been spent, you're not going to get it back, ignore it. And you can see why. You don't want to take a bad decision from the past and kind of feed it into the future. But let's see why it's so difficult to ignore sunk costs. Any of you actually stand in line at a bank anymore? I don't think so, right? We stand in. So let's suppose you stand in line somewhere. Okay, there are 15 people in front of you in line. You estimate, you look at your watch and say, look, there are 15 people, 2 minutes a person. In about 30 minutes I'll be at the front there, so you stand in line. 30 minutes later you look at your watch. There are 12 people in line still in front of you. You know you should just get out of the line and leave. But what do you tell yourself? I've already spent 30 minutes of my time. If I leave now, those 30 minutes are wasted. You see how completely illogical this is? Because it's wasted no matter what. Whether you leave now or don't leave now, it's not like time comes back to you. But as human beings, we cannot leave past decisions behind. There's a reason why the Yankees didn't cut A-Rod. If you know, third baseman who got 27 and 4 years ago. Everything logical would have said, hey, take whatever losses you can, let him go. But you know why they couldn't? Because Brian Cashman was still running the Yankees. You see, what's one got to do with the other? Who signed A-Rod to this contract? Cashman. And the very act of letting him go tells the world what? That was a mistake. It's actually at the core of what behavioral economists have found happens with investor portfolio. You know that we hold on to losers too long. You know what I mean by holding on to losers? You buy a stock and it goes down. There is substantial evidence that we sell winners too early and we hold losers too long. I won't even make it abstract. I've got Valiant in my portfolio. I look at my portfolio, I can't even see it anymore. It just seems to have disappeared. So I look at it, I don't see it. Because as long as I don't see it, the fact that I bought it at 27 doesn't jump out at me and say, you idiot, it's down to 11. I'm afraid to look at it because I'm afraid that it keeps room. And if I sell it, that's a final admission that I screwed up. So tomorrow I've got to write my post on Valiant, and this is something I have to face up to. How much of my holding on to Valiant is some discounted cash flow, intrinsic value rationale, and how much of this is just denial of saying, if I don't sell it, then it hasn't happened. Same thing with sunk costs, which is once something gets sunk, you feel this urge to bring it into the decision process. But here's, I think, the problem you face with sunk costs being what they are. When you think about test marketing or R&D, you spend the money first, right? You do the test marketing. So let's say you have a consumer product company that spent $100 million on test marketing. The test marketing comes back, and based on what you find out from the test marketing, you think that this product can create about $25 million in forward-looking value. So you spend $100 million already, but going forward, you think that this project will create enough cash flows to create $25 million value. Should you take this project? Yeah. But if you think about the collective value, including the test marketing, you've actually lost $75 million on this project, right? And if every single product that you produce has this characteristic, where you spend $100 million up front, and then you look forward and say it's going to make $25 million, you're not going to stay in business very long. So it's true sunk costs are sunk. But you also, as a company, have to keep track of how much are you sinking in costs and what are you getting in return. Because if you wait for costs to be sunk, your decisions are no longer impacted by it. But as a company, somebody's got to pay for those costs, right? This is the quandary that every pharmaceutical company faces today. What's the analogous sunk cost there? It's R&D, right? In the old days, here's what pharmaceutical companies used to do. They used to write a check to R&D. How much do you want? $3 billion? Here, I have $3 billion. Because what would happen is they'd spend the $3 billion, and because they had the pricing power, they'd be able to pass the $3 billion on to the cost of the drug. Today, their pricing power is shrinking, in spite of all the stories you heard. Partly because their biggest buyer is now the government through Medicare or Medicaid. So the bargaining powers have on the other side have increased. So today, if you wait to spend the $3 billion and then say, is this a good drug, you're going to be producing a lot of drugs that look good after the fact, after you spend the money. But as a company, you're not going to make it anymore. So what's the solution to this? Don't spend the money first and ask questions afterwards, right? Because if you spend the money first, it is a sunk cost. We need almost a preemptive, a first stage analysis, tough though it might be, as to whether you should be spending the $3 billion in the first place. And that's what you're increasingly seeing at pharmaceutical companies, is before you spend the R&D, they're asking, should we do it? Question that never used to be asked 20 years ago. And it's driving scientists crazy, because as a scientist, what do you want? Freedom to spend the money. It's a basic research. We don't know what will come out of it. But I'm pushing you now. It's basic research, but what do you think might come out of this? Because without making that judgment up front and asking some questions before, I'm going to be stuck with this position of spending money and worrying about it afterwards. And finally, unallocated costs. We saw allocated G&A, and I said 2/3 of it is fixed. So how would I know what's fixed and what's variable? Well, let's think about the essence of fixed and variable costs. If you have a fixed cost, it shouldn't change as your revenues change. If you have a variable cost, it should change with revenues. So I'm going to give you a very simple company. And I'm going to argue that with the data that I've given you, you should be able to break down its fixed and variable costs. So here's what you have. You have 3 years of revenues, $1 billion, 1.2, 1.5 billion, and 3 years of G&A costs, total G&A costs. So I come to you and say, tell me how much of this G&A cost is fixed. How would you answer that question? And as I said, I've kept it very simple. You should be able, you don't need a calculator. You should be able to, with that example, tell me how much of the cost is fixed. Or how much is variable, either portion. How much is fixed, you think? What did I say variable was? It's whatever moves with revenues, right? So as my revenues went from $1 billion to 1.5 billion, my G&A costs went from $250 million to $300 million. roughly speaking, it looks like the G&A cost is 10%. The variable G&A cost is about 10% of revenue, right? So 10% of 1,500 will be about 150 million variable cost. The rest of the cost is going to be fixed. It's very simplistic because you took a real company and you took revenues and G&A costs across time. You're not going to get this really nice pattern. But I think there's information in companies' history. You give me 35 years of Coca-Cola's G&A costs and revenues, I should be able to tell you whether the bulk of its costs, maybe not in specific percentage terms, whether the bulk of its costs are fixed or variable by looking at the movement between the two. Okay. In fact, if you want to get really fancy, what could you do? You could run a regression of G&A costs against revenues, and the coefficient on the revenue will tell you for every dollar in revenue how much will my G&A costs go up. It's the same thing, but you can see that you're giving me a more specific answer. Let me at least set up what's coming. So you got incremental cash flows. Last step in this process is to time weight the incremental cash flows. If any of you have an old finance book, if you open it, the new ones don't have it anymore, but the old ones used to have a present value table towards the end. Have you ever seen these where it'll tell you what a dollar is worth in 1 year, 2 years, 3 years? And here's what it'll look like. A dollar in 1 year is worth 92 cents. A dollar in 2 years is worth 8. And you can see a table down. That's really time weighting, because what am I telling you? When I look at a dollar, this is how much I'm going to weight the dollar depending on when I get it and how risky it is. Discounting a cash flow is just time weighting the cash flow. So both discounting and compounding are time weighting factors. Okay. I know you got that present value function in your calculator that you're very attached to. I'm too old for that, so basically I don't trust the present value function even though I know it works. So I prefer to use the equation because it gives me a little more control. If any of you have scientific calculators, you can make them financial calculators if the scientific calculators are programmable. Because here's what's embedded in your present value equation. There are only 5 types of cash flows, and only 5 that you can ever run into in finance. One is, of course, a single cash flow in the future. The second is an annuity, a constant cash flow every year for n years, 5, 10, 15 years. The third is a growing annuity. So when you use the payment button in your calculator, using the annuity formula. So basically that's what happens when you put payment N and R and present value. That's the equation that the calculator uses, and you can check it out if you want, to come up with the present value of an annuity. Here's an equation that's not in your calculator that you might think about programming in if you can program it in. It's a growing annuity. You're saying, what's a growing annuity? $100 growing at 20% a year for the next 25 years. And they say, what's the present value? There are 2 ways you can get the present value. One is the long way, which is to take every cash flow and discount it back to the present, 120, 144. The other is to use this growing annuity equation, and in one step, you'll get the present value of cash flows over the next 25 years with a 10% growth rate or a 15% growth rate. And then you get to 2 equations that are extraordinarily powerful but also extraordinarily dangerous. The first is a perpetuity, a cash flow that lasts forever, a constant cash flow. So basically you take the cash flow divided by the discount rate, you get the present value. And the second is called a growing perpetuity. Growing perpetuity is a cash flow that grows at a constant rate forever. If you think a perpetuity is mind-boggling, a growing perpetuity is even more so. So when we talk about time weighting the cash flows, and we'll end with this page, that's basically what we're talking about, is using those equations to come up with the present value of cash flows today. So here are the 2 ways you can time weight cash flows. One is you can take every single cash flow you have on a project, discount it back to today, add them all up, and come up with a net present value. And if that net present value is greater than 0, even if it's $1, it's a good project. It strikes a... What if it's only $1? Remember, this is $1 over and above your cost of capital. So net present value that's positive is a good project. If you don't like net present values, the other way you can come up with a time-weighted cash flow return is you can look for that discount rate that makes the net present value 0. It's called the internal rate of return. Remember the return on invested capital I showed you? That's the accounting number. The internal rate of return is the corporate finance analog to the return on invested capital. It's based on cash flows, time weights the cash flows. So on Wednesday when we start off, I'm going to compute the NPV and the IRR for the theme park. And you're going to see these cash flows play out. But you're ready to actually start getting earnings and cash flows for your case if you want, because you have all the tools you need to get to those numbers.
Another question. I see what you're saying about the default risk, but again, I feel like depending on where you are in the world, your perception of the default risk is pretty different. As an example,
Let's say you look at house in a you can say, I value that house at 300, but there's a price tag. So the perception that each of us has about the default risk is different. But when you're a company taking a profit, you have to take, you're a price taker. So this is the price of default risk in the marketplace. The fact that you think differently and I think differently is nice, but this is not our business to be betting on default risk. If you're a trader, you want to bet this kind of default risk, you can go around making money, right? You can like that too. But as a company like Disney, making a theme park investment, the question I ask is like this: is my skill set, is my competitive advantage building the best theme park? Or is it assessing where the world is getting default risk wrong? And my argument is, build a theme park, take the price of default risk. It could be wrong, but this isn't your business. Why go looking for trouble, but trying to be an expert in default risk?
I understand that. That makes sense. But I feel like that default risk failure
Let's make it
is
specific.
not.
Give me a country where you think default risk is overestimated. Make up a country for me.
I would say Iran. I'm from Iran.
That's a good choice. I agree with you. I think Iranian default risk is overestimated, right? So Iranian default risk is overestimated. It is affecting whether companies will invest in Iran, right? Because it's pushing up their hurdle rates and it's keeping them out of it. If I were a company that fell, and this is going to be more likely if I'm a company closer to Iran where I can look at the actual specifics. Let's face it, as a U.S. company, I'm looking at Iran and say, well, what do I know about Iran? I'm going to raise the rate. Let's say you are a company that actually knows, you're an Iranian company, you look around and say, oh, what these people are saying, there is no default risk here, or there's very little default risk. Take advantage of it. That's your arbitrage, right? Basically what you're doing is you're
The
taking...
German company has an office there, knows the market.
Exactly. And you say, look, and then you can go out and actually hedge the default risk if you feel like it. But you're taking advantage of the fact that you know something about the country that the rest of the world doesn't. And I'm glad you picked Iran, because Iran is an example of a country that a lot of the world doesn't know very well anymore, because it's been out of the market for so long that people assume, oh, it's the Middle East, it must be a risky country. They don't really factor in that Iran has a history in finance much, much longer than most Middle Eastern countries, that they've been doing business much longer than most of the Middle Eastern countries, and that the assessed risk might just reflect history that's a bad history, but that doesn't reflect what the facts on the ground. But I think you're more likely to take advantage of the Middle East, maybe not even an Iranian company, but maybe a Middle Eastern company that understands Iran than a company that doesn't. That's a good point.
I mean, how do you? I'm pretty sure there are more instances in the world.
No, but where Iran, I think, is uncommon. Part of the reason it's uncommon is I can't even buy default spreads on Iran. There's no sovereign CDS spread on Iran. The sovereign rating for Iran is only 2 years old, and the ratings agencies don't understand Iran because the Iranian government doesn't give them the information. They've tried to get more information in the financials, but they've kind of hit a brick wall so far. But I think you're going to see Iran actually make it more into the financial markets than usual. You're going to see CDS spreads. You're going to see the ratings that actually mean something. But we're in this period